So we have already discussed briefly about this topic called working capital. Anyone, any idea what working capital is? So during the project execution, finally this money is not used or consumed in the project, but during you need this money primarily because there is a delay in you getting payments from the client versus you need to pay to your suppliers the money. So that the working capital is essentially the capital that is needed for you to run your operations or projects smoothly, right? But now we have a more formal definition because working capital is not only a construction related thing, it's essentially a general phenomena, a general metric that you could see. And we have now good enough background to understand the formal definition, right? So the definition is the working capital is essentially your current assets minus the current liabilities, right? What are the current assets? Within 1 year, they should be convertible to cash or equivalent to cash, whatever. And current liabilities are also something that is payable within a year of that period that you are talking about. So the formal definition of working capital is, or it's also called sometimes the net working capital, is essentially current assets minus the current liability. And this current asset is sometimes called gross working capital, right? But the general definition is this. Does this make sense? Is this definition making sense from what we understood before? That working capital is something that you need to need for running the business smooth, whatever your debtors and the creditors. So this is the definition. Is it making sense? No? Logically, is it adding up? So essentially you are owing some money that you need to pay. The asset is something that you are going to receive, but you have not received in most cases. Of course, the cash is also one part of it, but current assets could in the form of debtors. So if you have more debtors, you need to, and you are paying more to your or less liabilities, your working capital is going to be higher, right? Because you have not been paid, but you are expected to pay to your supplier. So that remaining balance you need to supply through the working capital, right? Essentially. So again, but this metric is quite complicated. It's a simple metric in a way. It's quite powerful. It gives a short-term conditions assessment of the company. Only in the short term. It is not a long-term measure. It just reflects within a year how likely the company is going to finance its commitments and things like that. How much business capital does it require in order to meet its all requirement. That's the kind of assessment it does. But there are many, like how to interpret the results. Again, there are many things. Working capital less than 0. Is it a good thing to have working capital less than 0? Why not? Why or why not? So working capital less than 0 means that you have no money to support your short-term liabilities. And that is a high risk. It could be even an interest rate. It could be even a tax liability. It could be like a minor disruption or somewhere. So if you don't have working capital in the system, your system is too brittle, right? It is working maybe of the time, but it is too brittle and it immediately will break in any shock, in any kind of such shock appears. Working capital too much greater than 0. Is it a good thing? So if you have too much cash floating in your business, it means you are not running it efficiently. Your cash is not generating the revenues it should be generating as faster as you would ideally want to be, or basically your operations are not in an optimal stage. You have too much debtors, you have too frequently asking creditors, you are paying them too fast, but you are not negotiating on the client side and things like that. So the working capital, of course, there is no absolute value that working capital has to be $100 or $200, blah, blah. That's not the measure you cannot use because it depends upon the scale of the business and all. But working capital less than 0 is not a good indicator. Too much working capital is also not a good indicator. So definitely you need to minimize, but minimize does not mean that you have to go below 0. You cannot have like completely taken away the redundancy in your system. Basically, working capital gives you that flexibility that if something happens, you'll be able to meet your commitments without disturbing the business completely, right? So this is the main idea. I will also give you one source. Do you guys know about this? UPSC people must know about this. this Investopedia, just go through that. Some of these topics that we have been covering about financial assets and all these balance sheets and financial statements. Investopedia is one authentic source of information in a way that it's not Wikipedia where everyone could just update and you might be misguided sometimes. But Investopedia has people written a lot of good elaborate articles, simple examples for you to understand, real cases they try to update on the blogs and things. Just look also through, follow some of these discussions we are having in the class. If you want, I can give you a formal link of Investopedia with working capital, but essentially it deals with the same concept that I just introduced, right? So, current assets, we have seen any asset which can be converted into cash in the normal course of business within a year. Current liabilities, money owed by a business or any liability which is to be paid within a year, right? So, the components of current assets and current liabilities are, some of the examples are here. Cash, stocks, outstanding payment, prepaid expenses, deposits that you have made is typically your current assets. The vendor credit, advance received from the client, sales tax payable and deposit received from subcontractors and all, these are your current liabilities, right? This is typically a structure of working capital in a general firm. Some of these terms may be slightly different for construction, but essentially these are the things. So you have current assets in terms of the loans and the advances, the cash that is secured in different location, in your head office, in your transit, in your branches, in your bank you have accounts, current accounts and the fixed deposit. Current account is a business account essentially that deals with your money in your bank. Fixed deposits is some sort of an investment that you get frequent returns on. Marketable investment, debtors, stocks of raw material, consumable stores, work in progress and finished goods. All of these are some components of the current assets that we have already seen. And then on the other hand, there are current liabilities, which are all long-term liabilities maturing within the next 12 months. Provisions for dividends, taxes that you need to pay to your shareholders. Bank overdraft, essentially form of a loan or some sort of an advance credit. The credits, advances from customers and all, these are all part of your current liabilities. So the current assets minus current liability gives you the idea of working capital requirement, right? Clear? Make sense? All right. This is the same concept, what we have seen in terms of the formal definition, can also be explained using something called this operating cycle. So what happens in operating cycle? Essentially, you need cash to purchase of raw materials. This raw materials then becomes your stocks and stores. You have either raw material stock, some sort of a work in progress and all those things. You undertake production activity, which will also require some money, and you convert the material of raw stocks to finished goods or some work in progress, depending upon where you are, right? Once you have goods finished, you need to sell them to the market. Most of the time, sell is on credit. Credit could be just for a few hours, even when you are paying through the credit card. From your end, the bill has settled immediately. Credit card company still takes 3 days for the Amazon to credit its card account, right? So that 2-3 days cycle is still there for credit card company to manage. So whatever, there is a credit related sale. It's almost impossible to get 100% immediate sales. There is always going to be some sort of a credit in a business, unless you're talking about like live purchase transactions and all, that's a different thing. But most of the businesses do not work in that side, right? At least the large businesses. This leads to debtors, and then once you start collecting the money, it replenishes your cash related account statements and all those things, right? So essentially this operating cycle tells you the flow of money in your business. You need cash to buy raw materials, you use those raw materials to do the production, you sell those to produce to sell, and then collect the cash to replenish your cash account and keep the cycle on, right? Now, basically the size of this operating cycle, or essentially the delays, the more the delays in this operating cycle, the more your working capital requirements are going to be, right? If, for example, you have too much credit, you cannot stop this side of the circle. You still need to keep on doing this side of the circle, even though if you have too much credits. So in order to make sure that your left side of the circle is working, the production is still happening, you need to influx the money, and that inflates your credit cycle requirement, like your working capital requirement, right? Similarly, if your collection mechanism is too long, then also you cannot stop your left side of the activities to happen from, right? So you still need to fuel money, and that's the working capital requirement. Everything. If your purchase of raw materials is taking too long, you are not able to reach on the production cycle. So maybe you need to order in much more advance. If you are ordering in much more advance, or you are making more stocks, you need more money invested in the cycle. So essentially, delays in this operating cycle, the more the delays in this operating cycles are, the more your working capital requirement is, right? It can also be complicated by the more number of such cycles you are running in your business. If you have 10 SKUs, 10, for example, SKU is the variant that you get, right? For example, Tata Tea has, within Tata Tea, they have 3-4 different brands of green or whatever, the yellow mixes and all those things are there, right? Tata Nexon, one of the car that I'm looking at, it has 66 variants in the market. It can, even the operator or the salesperson cannot tell me all the variants in one go. So that is a huge problem, right? Then you will have to maintain for each of those 66 cycles, and that also compounds in terms of your working capital requirements, right? So just some of the factors that affects this working cycle, principle remains the same. Whatever could affect the delay across this working cycle will inflate your working capital requirement. Now, how could the delay get affected? Many factors. You could count endless number of factors. Some of them will be specific to your businesses. Some of them may not be specific to your businesses. Some are general, which would affect everyone. For example, season changes. How does season change? Can you think of a reason how season change affects the working capital requirement? So the demand of certain products is seasonal, right? So mango, fruits, perishable item, gifting items on holidays. You have, for example, in US, the Christmas and all this, there's a huge holiday. So you need to ramp up production before. You need to make your stocks are ready, because on those specific days, the sales are going to be huge. So in that time, you are preparing for like stocking of your materials way in advance. So that is inflating your working capital requirements, right? Opposite could also be there. Location of the plant, any idea? The more the time in transportation, the more in logistics related delays, it could affect your working capital requirement. Financial position of your client and subcontractor, that will essentially affect your collection mechanism, efficiency of your collection processes, or how much you are able to negotiate on credit or sell on the faster credit kind of a cycle and all. Changes of government and policies. Of course, government policy can affect the supply chain drastically, especially when you see in our country, huge transportation or supply chain happens through the trucking activities, right? And if you see on every border, whenever you are crossing a state border, you would see kilometers of lines, typically of trucks, because they have to get their permits checked, they have to get their goods, okay, we are transporting this good from here and there, all that checking that happens. If there is a change in the process of that, of course, it affects the whole supply chains, and many other government policies could affect the cycle in multiple ways. Again, for some businesses more than the other. So these are general factors. They could be more specific to your business also. I'm not saying that these are directly related to construction, may or may not be. Even in construction, for your sites, there could be differences in the working capital requirement affecting factors. Okay. RBI credit policy, how does it affect? Essentially, credit policies affect the liquidity of cash in general in the market. It defines how likely banks are going to lend you money, or how much money are they going to lend you easily and all. That affects everyone's ability to access cash. Even the creditor may require, your suppliers may require some cash to fulfill their requirements and so on and so forth. Same happens for client, for them to access the bank loans and all. So it affects everything. It is quite a fundamental thing. Availability of raw material, competitiveness, you can imagine. All those things are going to be there, right? Again, not claiming that this is an extensive set of list or an exhaustive set of list. It could vary depending upon what businesses you are in. But essentially, to optimize your working capital, you need to make this cycle go faster, as faster as you can make it go, right? So I'm just, in the rest of the class, I'm just going to give more examples of how you could optimize your working capital for construction related activities. So for example, it also is dependent upon the people. People are an essential part of working capital because they are making the decisions when to buy, when not to buy. A manager could be more like, no, I need more stock, compared to a one manager could be, no, I need to have more lean. I'm okay, this particular site is not as much risk or fluctuations of supply chain, so I will not have too much stock. So it also depends upon what you as a person perceive certain factors and how as a manager you are taking decisions about them. That also affects. So for example, depends upon the psyche of the manager dealing with the working capital. An aggressive manager would prefer less of current assets than the fixed assets. So their strategy could be to go lean. Lean essentially is making your business processes much more smooth so that your overall working capital requirement goes down. A conservative manager would stress more on the current assets than the fixed assets. In that case, they would have certain higher working capital requirements because they want to have more liquid assets. And there could be, of course, a combination or some sort of average managers and things like that. And in general, the proportion of the current assets to the fixed assets also impact how much is your return on investment, right? Let me show you an example. So let's say there are 3 types of managers. There's a total sales has been given to you. Earning before taxes is also same for all. The fixed asset in all those cases was also same, right? The current asset are different for 3 managers. In one case it is 60, other case is 50, third case it is 40. So 3 is the most aggressive manager in that sense because they are trying to reduce the current assets as much as possible. The total assets become, this particular case, ratio of your current assets to fixed assets is essentially 1.2:1 in this case, 1:1 in this case, and 0.8:1 in this case. The ROI, which is defined as the income before tax divided by the total assets, is highest for third type of decision making, which is essentially less working capital requirements, right? So, but less working capital is also, it's kind of a high risk, high reward strategy. The reward is higher because your total percentage or ROI percentage goes higher. But as I also mentioned, sometimes working capital is required as a redundancy in the system. If something fails, can you quickly fall back onto something else? In order to be prepared for that, you need to have working capital put in the system. So you cannot optimize it too much so as to bring it to the negative or close to the zero. If you do that, yes, your returns might go extremely higher, but then your business might also become brittle in a way that if some even minor external shock, it will not be able to pass it through, or resilience is something that we call, right? So in the short term, it can give you high rewards, but it can also make your business really less resilient to external shocks. So that's something that you need to, that's also a trade-off. Not everyone can, or every business can have a like extremely low working capital requirements. You need to have them also. And then again, depending upon what risk factors are affecting your businesses, you need to have some sort of a strategy around it. Okay, it's a topic in itself, it's a research topic in itself, it's an operations management topic in itself. People do MBA just on working capital management. So of course, we are just devoting 1 hour of our lives to this topic. There's a lot more that you can go deeper in terms of optimizing and how to calculate and all those things. Okay. So in general, how do you manage? So managing various components of current assets and current liabilities is the key. Essentially, the formula is clear. Working capital is current assets minus current liabilities. If you want to reduce, you need to decrease the current assets or increase the current liabilities, kind of a thing. Ultimately, it is around that, right? So need for capital cost management. Why do you need to do it? Of course, it is costly. Your money is stuck. It is not being productively used. It is not generating any returns. The money spent, money stuck in working capital could have been invested somewhere else to give you higher returns. Right now, it is not. So therefore, too much is not a good, right, idea. But it is necessary to have uninterrupted flow of work to sometime expand the volume of the business, as I told you in the example of the seasonal variation, because in order to ramp up or be prepared for expected demand surge, you need to ramp up your production right now and you need to put influx there. So working capital is necessary to expand the volume of your business. To meet the unseen contingency, it helps you have sufficient redundancy in the system. Sometimes it is also good for getting loans from the bank, because then banks, whenever they are trying to give you loan, they see your asset balance sheets, and higher number of asset is definitely good from the bank side. It means that you yourself as a business are able to fund. So bank would also like to be part of that journey, and therefore they are willing to give you credit for it, right? Banking system and everything only works for people who can really pay or who really don't need them. That is the rule of the market. People who really need bank loans most likely are not going to get a bank loan. If you don't need, everyone is selling you credit cards, selling you bank loan all the time. So that is how the market works. I can't be doing anything, but this is how it works. Essentially, everyone wants to make the money when you are doing good, right? So typically, for construction firm, these are the most generic form of assets, current assets, and these are the most generic form of current liabilities, right? I'm not going into details. So essentially, your working capital formula ideally should look like A plus B plus C plus D plus E plus F plus G minus H, I and J. All these components I've given to you. But in practice, some of these activities, again, civil engineers love simpler formulas. We don't like complicated, this is too complicated number equations for us. So essentially, we have a simpler calculation, which is just A plus B minus H. What is A? The stock. What is B? The money that you have not received from client. The money that you have already received from client. Simple. This is the most critical in most construction projects. Of course, it could change, and again, it could have more, it could have even J, K, L, M and no P, depending upon what you are tracking and how significant they are in terms of your particular project. But in most generic construction projects, this much is sufficient to get a rough idea of what's happening, which is your stock at site, your outstanding, the money that you have not gotten, and the money that you need to get or you have already gotten. Of course, vendor credit sometimes can become significant, but most of the time vendor credit does not go very high because vendor keep on asking and you are paying that back most of the time, so that's no longer a liability. Otherwise, it somehow does not work, right? So this is the generic formula. Again, giving you more detailed examples. Some of the strategies could be to manage your inventory, right? Because stock is contributing to enhancement of your working capital. So one of the things would be definitely to manage your inventory. So inventory management is balancing between the carrying cost and the loss because of reduction in sales. You remember we had done that simulation in Monte Carlo simulation about the inventory management and the stock calculation. If you do not maintain stock, you are on a possibility that on certain day you will not have the necessary equipment or machine or resources to do the activity. So your production of construction activity will stop. At the same time, if you have too much stock, that also is not good because you need to pay higher money to just put that on your balance sheet or even in your site to maintain that kind of a stock even in a physical sense, right? So high inventory is not good, and low inventory it can also have more issues. So somewhere optimal has to be there. High inventory has on monies blocked or inventories, cost of storage, cost of wastage, cost of inventory management, all this. If you are having a high inventory, then you need to devote more resources to manage this also. But low inventory, you could have an interruption, underutilization of capacity, also some cases loss of goodwill. I don't know why I put that. I'll have to check back. Why did I put that or what specific examples were there? But essentially you get the picture, right? In terms of inventory management, how do you, as a construction project manager, how do you typically do it? Essentially, you need to focus on non-moving items. You need to keep on examining how they are not flowing around your construction site. Are they at right time at the right location? All the resources that they need. Are they unnecessary in your stock? Why are they not moving? So you need to able to find reason and make sure that the resources go there. Avoid hoarding unnecessary stock. This is very easy because the stock's cost is not immediately visible, right? You are not paying per minute of uses of stock, but over the period it gets accumulated and starts reflecting in your balance sheet, and that's something which a lot of project management do not realize immediately. It's not like every day you are paying so much money to rent a stock space, right? It's a space on your site which is it's a fairly separate, but later you realize that this has so much costing associated with it, so that becomes the challenge. And you should do a thorough review. So that's a very generic recommendation. But essentially, you should have a project accountant on the site, thoroughly review what are the goods which are moving, not moving, how is the inventory management for each and every goods or resources on your particular site. And there are certain methods which are more theoretical than practical. Some cases you might achieve them in practice, some cases you don't. But essentially, there are two main theories that this tell you about it. First is the just-in-time inventory system. Essentially, it is a very theoretical situation, rarely that you can achieve in, especially in construction project. But the idea of just-in-time is that you will have that resources available to you on site just when you need it. So it's like zero inventory kind of a situation, but that does not happen, right? Because we have all the fragmented supply chains. Most of the time you are working in locations where they're not, you are creating the first set of road infrastructure to make the site accessible. In that case, how can you expect that cement supplier will be coming there just in time you are calling and things like that? So it's not ideal, or it's not practical, but you could still use this concept to identify which are the areas which require your attention, where the lead time is much more, where the lead time is less, and how could you improve those situations. So theory helps in identifying those pain points and then solve them. In your lean class, you might have used such kind of principles, and if you are not taking lean right now, you will soon do something like this. There's something called value stream mapping, which essentially highlights where exactly the delays are happening, why the delays are happening, and you can streamline some of those things, right? There's also a rule of thumb, it's called ABC analysis. Again, this is just rule of thumb. This is not a scientific theory, but the idea it says is that typically the high value items are very less in number, right? That's happened and that's quite commonly observable. The percentage may change, but what it says is that 70% value items are just 10% in the number, right? Similarly, 30%, there are some items which are contributing to 20% of the project values, but their volume constitute about 30% of the total constituents. And then there are type C items which overall contribute only about 10% in the value, but they constitute 60% in the total number. So which one should you more carefully manage? A, B or C? A, right? Because it's contributing huge, immensely in terms of your project value, and their volume is relatively less, so hopefully more manageable, right? So instead of devoting equal resources to all and then not be able to achieve anything, you could also identify activities like that which are contributing most to the value and are least in the percentage number, and therefore you can at least solve your problem by 70-80% even if you are not meeting the 100% target. So that's the kind of strategy, this principle. Again, depending upon the kind of activities that you are involved in, these percentage will always change. These are not static, so don't just be like, oh, 70%, 10% is not matching exactly. You get the idea. High value, low volume, high value items needs priority, right? Then at the same time, in working capital, your money that you need to receive from clients plays an important role, particularly for the construction companies, as I've already told you. So you need to have a really details of outstanding and the payment terms and condition. As a project manager, you need to be aware of what are the payment terms and condition, how do you get paid, and make sure that you comply with all the norms that you need to do in order to get the payment released, right? A lot of time it could be that a simple signature was not done on one particular document, and because of that client did not release the payment, unnecessary, even though you might have done all the work. But construction industry requires a lot of formal approvals, monitoring, auditing, everything. So as a project manager, you need to be aware what all steps do I need to do in order to get this payment into my account, release into my account. Whatever the documentation has to be there, right? So that there's no passing that. You cannot assume that this is a boring activity, why should I do that? But ultimately it affects your payment process in the particular project. TDS certificates, which is your tax deductible at source. This is also important. Sometimes because client do not have an incentive to give you TDS certificate immediately. They cut the money, they are paying less, of course. And for their regulatory compliance, they will always do it to their tax authorities. But they might not give you certificates to you because they don't have incentives. So you need to follow, get it done so that you can save on your taxation later. Otherwise, some money you are having double taxation, right? It happens with me personally. Typically, when you are earning money, somewhere around January, the accountant of your organization will ask you how much saving have you done, and accordingly they will release something called a Form 16, right? Form 16 is essentially how much money did the employer pay to you, right? And you can write at that time, you can mention the deductions clearly so that your Form 16 is reflective of all those deductions. In that case, your tax liability is automatically less. But I am super lazy person, especially around January. When they ask, I'm like, this is in March, why should I worry about this right now? I rarely disclose this to them. So the net income that they claim, the institute claim that they have given to me is higher, right? Later, I need to adjust this when I'm finally filing for my income tax returns. At that time, I mention it clearly, blah, blah, blah. And later, income tax department gives me money back. But for that 6 months, that money was with the income tax department, not in my account. Yes, I'm not super rich, so it is not very significant amount which is stuck with the income tax department. But for a project, it could be a really huge amount, right? So if you have a ability or an opportunity to get these are legal mechanisms. There's no harm. The Form 16 preparation is a legal mechanism provided by the tax authorities that you proactively declare and get the saving. I am not taking it, right? So essentially you need to be aware of all these tricks and tips, whatever the tips and tricks, so that you do not lose on some of the benefits that you are otherwise entitled to or could have reduced the working capital requirements, right? Claim for interest in case of the delayed payment and essentially some of the ideas. Reasons for delays to be properly reviewed. You need to have a proper mechanisms most of the time, continuously reviewing why the delays are happening. It could be of multiple reasons on a specific site. It could be n number of reasons, but essentially is the client giving issues in issuing the certificates? Is there a fund crisis? Is the communication between you and client not good? There could be n number of reasons. You cannot put everything here, but you need to identify those and then help resolve them so that you can get paid on time, right? And as a project manager, that becomes your responsibility in many, many cases, right? Advance payment, if you could do, of course, you should try to get as much as advance from client as much as possible, but this is where you will not likely have much success in most of the cases, but at least whatever you are otherwise entitled to, you should really work hard to get it. It's not automatic. Nothing in construction is automatic. You will deal with people on a daily basis. Some of you might have already dealt with people on daily basis who come from so variety of backgrounds, so variety of business practices. But you need to understand and at least make sure that their business practices are not affecting your business practices, right? Essentially, you should not lose out on money that you are otherwise entitled to. Other form of current assets, these are essentially the advance paid to subcontractor, and avoid excessive blockage of money than warranted. So you should not really pay too much to the vendors also. That's also a negotiating side. So as a project manager, you need to negotiate on both sides. You need to negotiate on the client side to get your money faster, and you need to negotiate on the vendor side to get the maximum credit possible in order to optimize your working capital, right? And of course, there's a power hierarchy. In certain cases, you are like the sole customer for the supplier, so you will be able to guide the payment terms in certain cases. In other cases, you may not, right? If you are purchasing steel from a really big steel plant which has 1,000 other customers, they will be able to negotiate the terms, not you on that particular side, right? So all, of course, there is a power hierarchy, all those management principle of negotiation, everything comes into the picture. Therefore, it's a very important management topic otherwise, right? Cash or bank balances also, it's like do not keep excessive cash bank balances as surplus. So yeah, essentially again it's saying that too much cash should be essentially utilized. Either you pay your vendors, either you put it in asset which is useful for your project. Do not keep it idle in the bank. It is not doing anything there. You need to also up your game of forecasting, projecting the demands of various requirements as much as possible, so that you are more optimal on the managing the supply chain constraints again. Monitor fund requirement periodically, bank reconciliation in terms of understanding what's your condition of account, how much transaction on an average are happening, are you spending too much, your client coming, not coming, all those things you can analyze. And this much you should also do on a personal basis. You should periodically review your own personal bank account just to see are there any hidden charges, are there any minor charges which you are not aware, unnecessary paid and all those things. Those are important, right? So same principles apply there. For vendor credits, you need to avail the maximum credit from the vendors. Meet the commitments on the due dates to maintain the reputation. You cannot be not paying them at all, otherwise they will not supply to you. So there's always a balance there. You have to have some sort of a realistic conditions. You cannot be assuming that you are in the power all the time and therefore you can always guide the payment condition. That's impossible. Every credit will have its limit, and if it doesn't work, if the vendor stops supplying, then your project gets affected. So instead of focusing that you are in the power position, ultimately your focus as a project manager should be on making sure that your project is also running. So not too much only on the power that I'll teach this subcontractor how to behave. You are not there to do that. You are there to make sure your project happens correctly, right? So pick your fights as a project manager. Your fights are on the site, not with the people around it. Those are negotiations to keep you alive in your main fight, right? That's the main idea. Similarly, advances from client, it could be contractual. So if as a project manager, you have opportunity to be early stage involved in the project, make sure that the payment terms are very clearly indicated in the contractual documents, because then you have a legal claim over the process. You have a legal, in case the client is not following the process, then you can also have the legal defense that this was part of the contract. We are adhering to our side of the deal processes. They are not. So therefore, I am eligible for more money from the client. So project manager is, I know you guys, some of you have real experiences, some of you have taken the theoretical classes in that, but it essentially is a really all sorts of skills. Money, law, people management, resource management, everything you will learn as a project manager. And therefore, typically you get to work on them after certain experiences in the site of different types of jobs, and then you go on to become project managers. An MBA graduate from any top business class in the world will be a terrible construction project manager. So it's not about we have read it. There's a lot of theory, difference between theory and the practice comes from the experiences and all those things. So yeah, it takes time to acquire those skills as well, right? On the liability side, of course, there are taxes. Don't play with them. Okay, taxes are for you to be paid. Don't think that, okay, this is where I can optimize my working capital requirement. No, this is not a component that you should be optimizing your working capital. Whatever your liabilities are, make sure that you pay on time. Yes, a lot of people do take advantage of that system also, in a way that it sometimes there's an informality in that. They know that this is going to get delayed, or if they know the process of how the government is going to enforce, you can take leeway. But no, as a project manager, this is something that you need to make sure that there is no legal claim on your business, right? So don't consider optimizing them. Consider all other things that I've taught you so far. And also, don't play with salaries and wages. Okay, this is also the classic thing. If I want to reduce my working capital requirement, okay, let's not pay the workers this month. They will anyhow, they don't have any other jobs, so they will still stay. Don't do that, right? Anything, even as I told, even if you have currently the power hierarchy, maybe you are in a higher negotiating term in certain condition, none of these power hierarchies are long term. If you are not paying the required salaries or vendor credits on time, they can jeopardize your project performance. So again, pick your battles. It's not about who's winning in those relationships. It's about whether your project is getting the good or the best it should get from you, right, as an output. Yeah. So this is, yeah, essentially all the kind of things that I've discussed with you. I'll have 1 minute. Just give me 1 minute. I'll just finish the remaining 2 slides. So in terms of the working capital also, sometimes people make a distinction between permanent and variable. It is still the distinction is still on the 1 year term. That is, it is on current assets and current liabilities. But even in that, there is a sense in permanent and variable. So permanent component of the working capital is something that you need for an enterprise to carry out the minimum level of activities, right? These activities are all individually solvable in a year's period, but you know that, or these are more or less anticipated level of activities, that this much working capital you will require no matter what you do, right? So consider financing them through the long-term sources. You know that out of my working capital requirement each year is going to be at least 1 lakh rupee plus minus 10,000 rupee, 20,000 rupee, like that. So that 1 lakh rupee should be borrowed from a long-term capital so that your rates of interest are lower. But the remaining 20 or whatever you can borrow from short-term sources so that you are not, everything is not on a short-term basis, right? So there is a predictable trend in your working capital versus there is some sort of an uncertainty. The uncertainty component you typically borrow from short-term financing sources, but the long-term predictable trend you tend to borrow from your long-term financial sources. So again, you are optimizing your financial burden of the working capital, right? Short-term sources are credit, bank overdraft, bill discounts. These are like fixed deposits, fixed things, and all those long-term commitments from the bank side, right? This is it. So we will essentially mentioning some sort of share of short-term funds versus long-term funds, a list, not necessarily applicable all of them for your project, but could be something that you worry about, right? So this is where we'll finish this topic.